Hello, I'm Anastasia Amoroso, and this is Beyond 60/40. Today, we're focusing on private equity secondaries, and we'll start with my private market pulse snapshot, where I'll share the one thing that caught my attention this week in private markets. Next up, Barry Miller, who's a partner at Ares Secondaries Group, will share his insights and predictions for this growing asset class. And then I sit down with Dana D'Auria, who is the co-CIO of Envestnet, to talk about extending the growth of our partnership and how Envestnet is leveraging tech to increase access to alts. Let's start breaking this down. In today's private market pulse snapshot, the one thing I'm focused on is the growth potential in the private equity secondaries market and the increasing demand for capital in the sector. The PE secondaries market has shown remarkable resilience amidst the fundraising challenges in the broader private markets in recent years. In 2023, for example, it was the only strategy to register a positive year-over-year change in fundraising, increasing by 60% from 2022, while other private market strategies saw a 24% decline. And in the first quarter of this year, secondaries had its highest fundraising quarter, going back all the way to 2008. However, despite this robust fundraising environment, the secondaries market remains severely undercapitalized, with capital being deployed faster than it is raised. For example, annual deal volumes or transactions have consistently outpaced annual fundraising levels every year since 2010, with the exception of 2020. And from 2021 to 2023, secondary funds raised roughly $185 billion, but deployed around $350 billion. This means that only 53 cents was raised for every dollar invested. So what does this imbalance mean? Well, the dry powder in the secondaries market, which is currently at $235 billion, is shrinking and doing so relatively quickly. Current estimates suggest that there are only about 12 to 20 months worth of actual dry powder available to fund secondaries transactions. And the demand for more secondaries transactions may still grow. Because, for example, buyout GPs hold roughly 28,000 unsold companies that are worth over $3 trillion in unrealized value, and they're expected to leverage the secondaries market to sell a portion of those positions. Now, that is likely to further tip the supply-demand imbalance in PE secondaries dry powder over the near and medium term. Now, importantly, the lack of available capital is not due to the lack of investor interest. In fact, investor allocations to secondaries have actually increased approximately 2 to 4 times over the last decade. And according to Hamilton Lane's Ryan Cooney, who we previously had on our show, investors are funding those increases by reducing their allocations to primary private equity as well as public equities. Similarly, according to a recent UBS Global Families Office report, nearly half, or 45%, of family offices plan to over-allocate their portfolios to secondaries. That's more than to any other private equity strategy or sector. Driving fresh capital to this undercapitalized industry is, in a word, performance. Secondaries delivered stellar returns with a 3-year horizon IRR of 20.6%, beating all other strategies, even private equity's 3-year horizon IRR of 19%. And in fact, secondaries are the only alternative asset class where even the lowest performing quartile of funds still manage to generate positive return. So where does this leave us? Well, we agree with investor sentiment that there's a lot to like about the PE secondaries market. Specifically, first off, PE buyout secondaries are still trading at a discount to NAV even after rebounding in 2022. This discount is 9% today in 23 versus 13% we saw in 2022, but it is still higher than the average just 5% discount seen between 2017 and 21. And secondly, the improving global macroeconomic backdrop and the disinflationary trends combined with stable GDP growth should support the private equity exit environment, meaning seasoned deals within the secondaries vintages may be closer to monetization than they've been before. And that indeed is a solid setup for this private equity secondary strategy. And that's your one thing in private markets this week. My guest today is Barry Miller, the Chief Executive Officer of Ares Private Markets Fund and partner in the Ares PE Secondaries Group. With approximately $25 billion in assets under management, Ares Secondaries Group is a pioneer with over 3 decades of experience delivering data-driven results across a range of alternative asset classes. With that, Barry, thank you so much for joining us today here in the studio.
Great, thank you for having me.
It is great to have you, and I'm really thrilled to have a conversation about the private equity secondaries market. I know you've been doing this for over 25 years, and it's definitely been a growth space within the industry. So just help us level set, where are we in the private equity secondaries environment today? It looks like last year the transaction volumes did perk up. We're up about 4%. So where are we? What's your big picture view for 2024?
So I think as we look at 2024, 2025 and beyond, within transaction volume, we need to look a little bit in the rearview mirror. So as we look at, yes, transaction volume definitely picked up this year. Previous year, we did roughly 115 billion, year before about 130. But as we look over the last 15 years, what's interesting about secondary volume is that every 5 years, transaction volume has doubled. So as we project that out over the next 3 or 4 years, we believe we should be able to get north of 200 billion. In addition to that is that's split. So the transaction volume is between the LP-led side and the GP-led side. Over the past few years, it's been split roughly 50-50. But as you go back over the last 3 or 4 years, or even a little bit longer, what you'll see is the current GP-led volume is greater than overall transaction volume has been. So we've seen a real spike up in GP-led volume. We've seen a real spike up in overall LP volume. And as we think about it going forward, we feel highly confident that we should continue to see growth.
Right, so there's the GP-led side and the LP-led side. Let's dig a little bit deeper into each one of them. So as a private investor, why do I want to give the GP more time to execute, on a turnaround plan or whatever it may be, that they have not been able to accomplish while they were holding the company in their fund?
So I think as you look at it with the GP-led, there's really 3 areas of focus. So the first is exactly as you said, the duration of the company doesn't match the duration of where it sits in the life of the fund. It just needs more time. The second piece is that they're looking to do some sort of transformational acquisition and they need a little bit more money. And then the third is that high-class problem or a high-class challenge is that they need to get some money back to their investors. But overall, when you look at it, you wouldn't do a GP-led deal with an underperforming company. You do a GP-led with a star asset. So an asset that is generally given existing investors somewhere north of a 2.5 times multiple. You want to focus on a company that's doing well, that's performing well, and just needs one of those kind of 2 or 3 attributes.
Yeah, more time, more money. And then on the LP side, we had this notion of the denominator effect back in 2022, where the private equity assets held really well, the public markets have really suffered. So as a result, you were a little bit off size and you had to trim back your private equity allocations, and that's what led to the volume of PE secondaries. But fast forward to 2023, and you don't have the same denominator effect and going into 2024. So what's driving the LP transaction volumes?
So LPs today are seeking liquidity. The DPI, or the dollars paid in, as investors look at their individual portfolios, there's just not enough money coming back in these portfolios. So how do you create liquidity? You can enter the second.
Because there are no exits.
Correct. We'll say that there are fewer exits than they had anticipated.
Right.
And so as you look at it today, they're looking for liquidity. So investors may sell their entire portfolio, they may sell a portion of their portfolio. How are they going to generate liquidity? I think the second piece here is that for large investors in the asset class, there's been a fundamental shift in how they invest. So it used to be you built a large diversified portfolio, your returns migrated to the mean, and the mean was okay. It's been a strong performing asset class. The other piece here is that the largest investors in our asset class are public pension plans. Think about them as battleships, these massive machines. They don't turn on a dime.
Right.
And so the first thing they need to do is build out their rebalancing range, and then over time they will enter the secondary market as a seller. And we're consistently seeing large plans enter, but they're not selling individual funds. They're selling relationships. So I'm not going to be with Fund X anymore, I'm going to go to Fund Y, but I'm going to sell all 5 funds. And then they say, well, I'm now going to commit more money to the next group. So when you put it all together, there's both secular and cyclical tailwinds behind us that would suggest that the market should continue to grow and be robust. So I think as you look at some of the large public pension plans, while some may be more funded, they have been historically. In general, when you look at them, they remain still underfunded. When you look at some of the large non-US investors are continuing to deploy significant amounts of dollars in the asset class. But the one area that is the most underpenetrated within the asset class is the wealth channel. The high net worth, the ultra high net worth, the mass affluent. And that's where we're seeing a pretty significant pickup from a deployment standpoint. And as that continues to grow, our transaction volume as an industry will grow.
That's the additional source of dry powder and future capital. And of course, we know the numbers. If there's $135 trillion of assets for institutions, that's actually pretty well matched with what's out there in terms of private wealth. And the penetration rate, of course, is not 30 or 40, but closer to probably 2 to 5%. And you mentioned returns, so let's talk about returns and how do you drive returns. Returns for private equity secondaries have been quite strong over the last number of years, double-digit returns. So how do you create value as a secondaries manager in the space?
We create value three ways. So we look to buy assets at a discount, or a discount to NAV, a discount to intrinsic value. We look to buy assets that are growing. And the third way is financial engineering. So being able to use a little bit of leverage, although today with where rates are is a little bit more difficult. And then we use portfolio management. That's the wrapper.
The other factor to success in secondaries, I assume, is your ability to source deals. So what's the secret sauce for you, for Ares, in sourcing those?
Our secondary business really is in the center of everything that Ares does. So we have a large direct lending platform. We believe we're the largest non-bank lender globally, covering 900 sponsors, seeing 3,000 companies a year. So a great sourcing funnel for us. We have a direct private equity business. Think about that more of industry and domain expertise. So if we found a great company or a great group of companies, understanding the industry we think is important. We need to make sure we finance it correctly. So we have our alternative credit business as we think about financing many of our peers. And then we have a group of global client solutions, high net worth distribution, where effectively are just blanketing the world. So as we think about it, whether it's sourcing from the investment team, whether it's sourcing it from global client solutions, from the institutional or the wealth side, we feel we've got it covered.
Right. Well, speaking of blanketing the world, I know you're going to be everywhere between Dubai and Arizona. So Barry, it's a great perspective. And just the last question that I have for you, how does a private wealth client access this? How available is this asset class to us?
That is a great question as we look at today, because that answer has shifted so much over the last 5 to 10 years. So as we look at it today, there's been this democratization of private markets. 2 years ago, we launched the Ares Private Markets Fund, which was to bring institutional private equity to the mass affluent, the high net worth, and the ultra high net worth, effectively bringing that 30-year history we have in institutional private equity. And so now we're able to deliver it. We're delivering it in a product that is focused on secondaries, predominantly private equity secondaries, focused on buyout, focused on North America. So as we look at the market today, I think part of it was, it's not that there wasn't an appetite for it, there wasn't the appropriate products. And now we as an industry, we have been able to deliver this democratization. That's the word that people talk about. This democratization, being able to bring these same products that are in line, have similar return profiles, have similar assets. And I think today we've also lowered the minimums for people to come in.
Well, we've certainly come a long way as an industry in terms of product innovation and really making this institutional asset class that it used to be much more accessible to the private wealth client. So Barry, thank you so much for sharing your perspective with us on private equity secondaries. And obviously this is a growing asset class. And what I really liked about our discussion is that it's not that institutional investors don't want to be in private equity, it's just that have compelling reasons to lighten up. But that's what gives us an opportunity as an investor to step in, buy some of these potentially great companies at a discount, and continue to mitigate the J curve and creating value. So Barry, thank you so much for shedding light on that for us.
Great. Thank you very much. I appreciate it.
Thank you. Today in our Spotlight series, I am joined by Dana D'Auria, Group President and Co-CIO of Envestnet Solutions. Specializing in wealth management technology, iCapital and Envestnet recently expanded our partnership to include alternative investments. Thanks so much, Dana, for being here today. Thanks so much for joining us.
My pleasure.
It's great to have you here. And, let's start in the very beginning, which is tell us a little bit about Envestnet. What might the audience not know about the company?
Well, they'd be not blamed for not knowing because, of course, we are B2B. So we're sort of in the background of a lot of brand names that folks probably do know, like Mass Mutual or Osaic or Sotera, right? These are introducing broker-dealers who use the Envestnet platform. Envestnet is basically it's overused word, but an ecosystem, a financial ecosystem used by broker-dealer clients and RIAs to actuate their advisory business. So proposal generation, creating documentation, billing, reporting, and then around that, all of the kind of pieces that, a financial advisor might want to use, like financial planning, data and analytics for insights, spending insights, et cetera.
So really everything the financial advisor may want and need in their fingertips to transact and do the public markets business in their practice. And of course, your role is also very expansive because you're the co-CIO for Envestnet Solutions, and also you serve as the group president. So tell me a little bit about both of those.
Sure. So I have a foot in the investment side as co-CIO. But the group president role is really running the P&L of the investment side. And that is pretty much our TAMP, right? So our Turnkey Asset Management Program, which is our AUM-based business. We work with about 800 different managers who are on our platform, providing their solutions to the advisors that use our platform, really more than 100,000 advisors. And then within that, we also have our own investment management, the in-house, and it runs the gamut from models of ETFs and mutual funds to direct indexing solutions, tax overlay solutions, CIO support, et cetera.
And so let's pivot to the relationship between iCapital and Envestnet, speaking of the business side of it. So how did that come about and what's the focus today? How is it evolving?
It's a fantastic relationship. And, Envestnet always kind of looks at any market and says, okay, should we build, should we buy, or should we partner? And in the case of alternatives and structured notes, the partnership with iCapital is really a fantastic one for us to deliver the best that we can to our clients, to our mutual clients. On the alternative side, it's an SSO and a reporting feed. Mm-hmm. And then on the structured note side, it's actually a proposal integration where you can go through our proposal, go out to the iCapital infrastructure, pick out a structured note, have that come back into our system, and you can look at overall risk. So it's a very nice complement of services. We have a robust high net worth offering, and certainly that partnership is great for that.
All right. And so it's interesting that it's both sides of the equation, which is the structured investments and also the alternatives. And so you must see the demand from advisors for both sets of products. So how is that demand evolving? And, is there one area or another that's attracting more demand from advisors?
We're definitely seeing an increase in both, certainly structured products, defined outcome products, but also alternatives. There's always been a cohort of advisors who are very good at these different product classes. They're doing them, via an iCapital or even, directly. But the wealth management, we have so many advisors who want to get into that space. And we're increasingly seeing broker dealers as well who are saying, home offices who are saying, how do we make this easier for our advisors that they can use these types of products and get better access for their clients to some of these alternative, return streams and different outcome vehicles.
Right. Well, speaking of access, historically, access has been the pain point in the market. But I'm curious, what pain points do you see today that still need solving? And I assume tech is playing a big part of solving those.
Yes, 100%. When you talk about democratizing access and enabling people to get access to a private market return stream, a lot of the times it is, how does this integrate with the way that the advisor does business today? And so the way that we see tech solving this, of course, is better and better integration between, an iCapital and Envestnet, where the advisor can go through one sort of workflow and be able to get both their public market and their private market or hedge fund or structured note, right, structured product needs met. So I think tech and continuing to move forward on integrations is a big piece. The other thing I think too is product innovation. You're seeing a lot of folks, obviously a lot of these private market and hedge fund managers want to come down market. So they're looking at innovative, interval funds, for example, products.
That again is so key because I think the products of the past were built for institutional clients. And if we are to move forward, we need to think about what types of clients, what types of needs do private clients have and what kind of products do we need to build for that. So speaking of that future state, as you think about both of our organizations working together, what's the future state look like? What are we working towards?
we have a roadmap that's going to get us to a place where we have a really nice integration. Not only the proposal generation and the advisor being able to see this overall holistic allocation, but also even being able to manage that allocation together. The Unified Managed Account program is our best program because it has the most flexibility. It enables the advisor to put an SMA next to an ETF, next to a model. What we would like to see happen and where the roadmap needs to go is our respective platforms enable the advisor to have either a UMA or a unified managed household experience where they're managing these types of instruments all together in one package.
That's an extremely impactful goal because clearly being able to manage the portfolio holistically, with a single platform, everything at your fingertips, it is so key for really growing from the allocations where they may be today of 5% or less to alternatives towards that 20%. Being able to manage that all in one is so key. So it's on the roadmap, it's the destination, and we're very much looking forward to getting there together with you. So Dana, thanks so much for joining us today and for sharing your insights on how tech is enabling access to alternatives. And thank you for your continued partnership.
Happy to be here.
Thanks, Dana. And we'd like to hear from you. Send us an email at yourquestion@icapitalnetwork.com and let us know what questions are at the forefront for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today. We'll see you next time on Beyond 60/40.